You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Quattro listeners, Real Estate Runway listeners, rather, we have a returning guest, Mr. Jeff Davis, who is going to come not from the real estate investor perspective, but talking to us about supply chain. He's actively in the supply chain world today with major carriers and major buyers of product. And we're really going to kind of talk about the tangible side of what, printing money in 2020 has caused, why we're seeing inflation, and the fact that it's really a supply chain induced inflationary time. And we're going to use that data to forecast a little bit into what the future looks like, because when you're in supply chain and logistics, you're really looking at things 12 months out. And so very interesting to look at supporting our claims that 2023 will be an interesting year, probably filled with pain in the first half and goodness in the second half. So with that said, let's get right onto the episode. All right. Welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton. We're powered by Quattro Capital. In our episode today, everyone, we are welcoming back a dear friend of mine, Jeff Davis, to the show. We recorded with him a few weeks ago, so you probably just listened to his episode talking about his company and his story. But before we get into his take on what we're going through today in this economy, if you get any value out of this show, please scroll down, leave us that 5-star review and a thoughtful comment. Folks, those ratings and comments are worth their weight in gold and are the only way to increase the reach of the show. You can also follow us via our parent company, Quattro Capital, on Instagram, Facebook, and LinkedIn. One word, no special characters, or by simply visiting us at thequattroway.com. And we appreciate all of you, our listeners. Love to hear from you. If you want content requests, feedback, or just want to say hello, drop us a note at podcast@thequattroway.com. And as always, if you want to be on the show, please visit us at thequattroway.com/podcast. Now on to your scheduled presentation. Jeff, welcome back to the show, brother. How you doing today?
I'm doing well, man. I'm glad that I'm not alone in some of my simple struggles. Just getting words out sometime is a challenge.
We're going to see how good my editors are, because what he's laughing at is I got tongue twister tied a few times in the intro there. And hopefully you didn't hear that. But if you do, life is life. Here we are. So anyway. All right, Jeff. Well, wanted to welcome you back on the show. And really, you have a breadth of experience in the supply chain world, which of course is, at the root and quite possibly hugely impacted by the inflationary market that we're in. So just wanted to bring you back on and kind of walk into your view on what's going on today, what parallels we can draw to the world of supply chain, and just maybe that'll help us understand what all we're going through today. So let me just kind of pass it over to you, and let's start there and see where this goes, shall we?
Yeah, and I appreciate that complimentary introduction. I do have experience, right? I've been doing it a long time. I enjoy it, and it is a unique industry that we are in because we're touching all parts of the globe, and for the most part, we're not tied to a single industry, and so we get to be in the most delicate part of any single industry. So that part is unique, and it's fun, and it's very dynamic. We get to kind of see about 6 to 12 months ahead of time, because supply chains have to start so early in any organization. There's a lead time, and as well as, a delivery date for a project execution. So breadth of knowledge, I don't know, but I at least had some time in the business.
Yeah, for sure. And drawing parallels a little bit, to the audience here, why do we have someone in supply chain who's also in real estate on the show? Well, supply chain is a very important part of the machine that is real estate development, real estate redevelopment. I mean, anyone who's doing a renovation or a repair or anything like that, we all have to buy product, right? And so a supply chain is relevant to our world in that way. But what I'm keenly curious about is, and you're starting to see economists, lean on this a little bit. The world of supply chain can kind of foreshadow what is to come 6 to 12 months in the future because of what you just alluded to. For example, let's use an aircraft engine because I come from that world. Back when we
Hmm.
were designing those parts, if we wanted to build an engine or let's say we needed to build 500,000 engines to support 500,000 airplane sales in the future. Well, we have to be forecasting that demand 18 months in advance because we got to start manufacturing those things. You can't just assemble those in a sweatshop, right? It takes time to make the parts and the subcomponents and all that. So let's kind of dive into that a little bit. How can we look at the supply chain world
Hmm.
and start to peer into the future a little bit?
Yeah, so I'll do my best to help you out, but you gave a fantastic analogy there with the aircraft engines and just their parts and their lead times. And so if we go back to 2020, uh, retailers, whether they're Lowe's or Home Depot for a home builder or a multifamily builder, or they're a store, a retail shop, Bed Bath and Beyond and Walmart, they had already done their forecast for 2020, right? They have already stocked their distribution centers and their store shelves based on a 2019 forecast of 2020. They did not foresee that every American consumer was going to be stuck at home with nowhere to spend their dollars except for on their iPhones, on their laptops, delivering for at home delivery. And that really drove demand to an all time high for the next 2 years.
Yeah, that's pretty incredible. And so that's looking back a little bit. What can we see in the real estate market today? Sorry, the real estate market. What can we see in the supply chain world today that might help us start to look at what's coming in the future? I mean, are we seeing,
Yeah.
a slowdown in this stuff? Are we seeing hiring still happen? Are we, I'm just curious what we can see in the future with that.
Hmm. So as these organizations are trying to just feed this feeding frenzy of consumer demand, building supply stores are trying to feed that building frenzy. That's where it ties in with a multifamily builder or a multifamily syndicator trying to meet a project deadline, right? Sinks and faucets and lights, everything comes from overseas, but you can't compete with just an all-time high demand and shelves being just stripped bare. So these retail outlets have been restocking their shelves, but with prices that are at 10 times their normal price pre-COVID. So they've been doing that for the past year, right? So now everything working itself through the distribution channels has a much higher cost of goods sold. And in the logistics world, what used to cost $2,000 to go from China into Houston was up to $30,000 as recently as May of this year. And so you can just kind of imagine all of these costs finally working themselves through the distribution network into the consumers. And aside from a syndicator with a project timeline and budget, think of it from every day, right? You and me and our renters. Everybody's going to be hit in the pocketbook with these inflated costs. And that's a huge part of what drove inflation.
Yeah, that makes a lot of sense. And all the decisions that we as consumers, but that the Federal Reserve and the powers that be in the government are making today, they really lag their impact by 12 to 18
Mm-hmm.
months in most cases. And so we are as of this recording in late November. Sorry, yes, late
Mm-hmm.
November. I had to check the calendar. 2022. Wow, can't believe it's that late already.
I
And
know.
so we're almost 18 months in from when a lot of we printed a lot of money in COVID to ease the suffering of the shutdown when we literally brought the economy to a screeching halt for the first time since Noah's Ark,
Right.
and
Right.
And so the impact of that is, when we pumped all that money in, some of it was used for operations, some of it was used for living expenses, but money is always moving. It's always in circulation. And so it eventually makes its way into certain pockets, where a lot of the consumer spending goes. And, the next thing that happened is we got into a supply and demand imbalance where all of a sudden we did have a supply chain crisis because, to your point,
Right.
everyone was shut down for a while. So that was a clear and present lag or literally shutdown in manufacturing. And so we created an artificial demand problem, which, guess what? Everyone had more money. So they were willing to go and spend more money to get things that are in higher demand. Go ahead. You're going to interject something.
I was going to say, not only did they have more money, but they had nowhere else to spend it. You
Right.
can't go to concerts. You can't go to festivals. You're not allowed to travel. Where else can you spend your money except for a select few retail outlets, Lowe's, Home Depot, and Walmart, and online? So what money you did have went one place, and that was to Asia manufactured goods.
Yeah. And so the interesting thing is the initial spike in pricing was really due to a supply chain induced demand problem
Huge.
because we could not
Correct.
manufacture stuff for a long time, right? And so there was that
Correct.
problem. But you mentioned something earlier that is the cost of goods sold now has caught up to the high prices, meaning we're probably going to see prices increase again as vendors try to maintain some sort of a profit margin. What do you think has driven the cost of goods sold to increase in a delayed fashion, but now, to kind of catch up to where the demand-based pricing moved?
Yeah, so here's how logistics works. It's kind of fun because I mentioned that 12-month foresight that we kind of have, right? So May was really kind of March, April, and May really hit the peak of those shipping costs. June of 2022, those prices fell about 50%.
Wow.
And at that time, I was doing similar podcasts and stating that, hey, it went from 30,000 to 15,000. And it will not surprise me if we are at pre-pandemic costing by November. And we're there, right? Now, by the same token, this huge spike in cost began in 2020 and really started in 2021 to spike. So you've got that 1 year lag time of that effect, that actual price level to work itself through the distribution channels. And so if we're looking at June when the decreases began to now where they're normalized and probably next month going below pre-pandemic levels, I would say that by June of next year to September of next year, we're going to be looking at a pre-pandemic inflationary, where inflation is reduced dramatically from a purely supply chain standpoint.
So that's interesting. So in
So
essence,
good news. Good news.
Yeah, that's good news, right? Is there may be an end in sight here.
Right.
And I guess the curious thing, we can maybe talk about whether or not the Fed's hiking interest rates or the Fed hiking interest rates has had a play in this. But so basically we created a supply chain induced demand problem, and the supply chain has now had time to catch up, which means there's not boats sitting in the harbor trying to offload. So demand and shipping is now coming down a little bit, perhaps
Tremendously.
and perhaps since everyone's looking forward, and this may be where the human behavior comes in as a response to the interest rate increases, perhaps we are starting to see logistical forecasts that are showing decreased spending in 2023, and therefore pulling back on manufacturing and things of that sort, and therefore preparing for a recession that may or may not have been coming, but is now designed in with human behavior.
I think all of those things you just said, right? Except you said it more eloquently than me.
It's
but
always,
to your point, talking about the interest rate, they're looking back, right? They're going to look back
right.
3 to 6 months. So if inflation is gone by June of next year, given a 9 to 12 month timeline of supply chain cost reductions and normalizations, then by June to September of next year, is when it actually occurs. And they're going to look in December of next year backwards for potential reduction in interest rate because they're not looking forward. And they've been very hawkish, very aggressive.
Yes.
And so, and in my opinion, doing the right thing. I think inflation's a bad thing. And they're taking a very aggressive stance. And so maybe if it's coupled with the supply chain cost reductions, we see inflation gone sooner, and normalization sooner, which I would love.
It's very interesting to look at the big picture. And folks, whether you're investing in real estate or tech businesses or whatever it is, you kind of have to become a student of the economy, which is nothing more than the ocean all of us fish and boats swim in, right? And so when you think about what's going on within the economic environment, what we're seeing is, we have the tactical and the tangible behavior of the cause and effect relationship of what we did back in 2020, and we just spent a whole 20 minutes talking about how that manifested itself to the prices you pay in goods. And now what we're seeing is we're seeing the Federal Reserve start to impact the human factor, which is, hey, I get that prices are high, but when money is cheap, I don't care. I'll just borrow money and buy more. I mean, you go look at Ray Dalio's videos, guys, on how the economic machine works. It's a 30-minute video on YouTube. You'll totally get what I'm talking about here if you just go spend 30 minutes of your life and watch that video, or it sounds really funny if you watch it at 2x speed in 15 minutes. But anyway, I digress. So if you go watch that video, you see that everyone's debt is someone else's income. So it doesn't matter if I'm buying a car and I decide to take out, effectively free money at 2 or 3% when inflation's 3 or higher and go buy that car. I'm still going to buy a car at an elevated price because money is cheap. When money then becomes expensive, you start to halt that human behavior of buying at elevated prices, whether that's, and we're seeing that in real estate too. Prices are coming down because debt is too expensive and we don't want to borrow that much of it, right? It's exactly how the system works, for better or for worse. And so what I love here is we're putting the theory together with the numbers, Jeff and I are, and this is all supporting our thesis that 2023 is going to have some temporary pain. And in the real estate market, the reason is a lot of these operators who are young have bought, properties with debt fund money with high spreads over the floating index rate, and they are bleeding, y'all. They are going to bleed out because their interest rate is 2 and 2.5x what they thought it would be. And there's going to be some real opportunities from those who made bad business decisions with cheap money at the time that was variable. But other than that, fundamentals are strong. And if what Jeff and I are putting our heads together to create is true, by the time we get to middle of next year, we're going to see that the cost structure has now corrected itself because we've normalized demand with the increased cost of money and the reduced supply chain and logistics backlog. And by the time we get to the end of 2023, we start to see interest rates come down in a 2 to 3 month look back by the Fed, and then we'll get to a new normal. Don't expect to go back to Disney World, the happiest place on earth, of interest rates at 0%. I don't think we're going to go there, but I love that we just kind of came together and made that assertion that it's probably going to level out there. So anyway, got on a soapbox for a minute. Anything you'd like to add to that conversation, Jeff?
No, I really like how you brought it all together because I feel like it's kind of scrambled eggs in my head sometimes, but I geek out on it. I just had a visitor in. I had to drop them off at the airport and was saying the very same thing, right? As we get into this economics, I'm actually reading Ray Dalio's book right now. So,
sorry, really, which one are you reading? The Changing World Order or the other one?
Principles
of Economics. Yeah, another great book. So yeah,
and I got to get to the Changing World Order. I just wanted to read his first one first. But exactly, I'm in line with you exactly about. You've got to understand, at least at a very rudimentary level, the effect that the Fed has on the interest rate. and also the effect that we had 2 years ago with just free money spending on everything. And to tie in with your Disney World reference, I was just in Tennessee. We did go to Dollywood, and it was, according to them, a record-breaking day, the busiest day in their history. I literally got to ride one ride. It was nuts. Okay.
Wow.
And so on the ride back, my daughter's talking to me and asking me questions. What's a recession and all these things. And I made the point exactly like you kind of alluded to, of that's going to taper down. This number of people going on these super extravagant vacations, that free money, right? It's available today. And I believe that next year we're going to see the effect of this tightening up, and that should temper down. And maybe I'll go to Dollywood when it's not so crowded.
Yeah, for sure. So for all who are listening, plan your vacations for 2023 if you're smart with your money, because you'll probably get good deals at that point. So
yeah, we're looking at some good furniture. I'm hoping to get a good furniture discount next year.
Yeah,
and that's what I've also been telling people from a logistics standpoint. Look at your furniture, because they got hit hard with these high costs, and that's a very sensitive commodity to the consumer. So probably in the next, December, January, you're going to see some good discounts on furniture.
Yeah. Anyway, I know we've done a lot of podcasts, folks, talking about inflation and everything of this sort and the economy. It's very important to understand the ocean you're swimming in as investors and as business operators. But if I can say one bit of good news, I mean, this kind of was good news, talking about, look, there is light at the end of the tunnel. Hope is on the way. The real estate market is strong, especially the rental market. People who were initially, on the upper end of renterhood and home buyers are now not home buyers because the interest rates have lowered their affordability index. And so therefore, the rental market continues to and will continue to be strong even in this recession. I would be careful with some lower quality resident bases if they're very susceptible to job loss or lower income. That may be a challenge for some people who are already paycheck to paycheck. But in general, especially if the labor market still has yet to loosen rather than tighten, people still employed, people still paying rent. It's all good. So with that being said, everyone, this has been another episode of the Real Estate Runway podcast inflation series. I need to go number these. Until next time, over and out. All right, Real Estate Runway family, sorry for the postscript we interluded in there. Just couldn't stop that conversation, had to get it. But don't forget, if you have any value out of today's show, please scroll down, leave us a 5-star review and a thoughtful comment. Those ratings really help the show, worth their weight in gold, and it's the only way we grow this show. So really would appreciate you doing that. You can also follow us via our parent company on Instagram, Facebook, and LinkedIn at Team Quattro Capital, one word, no special characters, or by simply visiting us at thequattroway.com. Until next time, and really this time, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway podcast.